Time now for a deeper dive into some competing tax plans. Robert Frank is at the table this morning. He joins us with a look at the proposals from Trump, Biden, and yes, lawmakers. Good morning.
Good morning, Andrew. So much tax news yesterday. Former President Trump floating a number of ideas in recent days. Yesterday, he proposed using revenue from tariffs to lower or even eliminate the income tax. He also talked about exempting tip wages from income taxes. Tax analysts say both proposals, of course, would reduce revenue. But the big question is how he's going to raise revenue if you extend the 2017 tax cuts. They expire at the end of next year. That would cost $4.6 trillion over the next 10 years. Now, some Republicans propose taking the $10,000 deduction on state and local income taxes to zero. That would generate about $1.5 trillion, mainly from blue states. Others propose cutting green energy and social programs. Republicans also say the extended tax cuts would pay for themselves with stronger economic growth. Yet independent estimates say even faster growth would only offset about 1 to 14% of that revenue loss. Now, Biden's plan calls for extending cuts for those making less than $400,000 a year, and he's proposing more than $5 trillion in tax hikes for companies in the wealthy. Andrew, you were talking to Janet Yellen yesterday about sort of how much of that deficit reduction is tax increases on the wealthy and companies. It's $5 trillion. So you have two very different approaches to how you deal with his expiration at the end of next year.
Right. What about you think just about collecting taxes under the two potential presidents in the next term? If you think about it, if you think there's 600 or 800, in
the tax gap, you mean?
Yeah, the tax gap. But we keep talking about, the IRS getting money, being funded, defunded, where they're going to go find that money. I think most of that money, frankly, is going to be found actually at corporations.
Yes.
And, complex partnerships. Yeah. More of the complex partnerships than even
large partnerships
than even the wealthy, per se.
Yeah, and that'll be really interesting, too, is when you look at how they're going to raise revenue, one of the things the Republicans may do to cut costs is to cut that what is now $60 billion left over from the $80 billion that was given to the IRS. So it's not a lot of money, and I think you get more per dollar paid to the IRS in returns than
bang
you get.
For the buck, yes.
Yeah, exactly. So it's whether it's 1 to 5 or 1 to 6. But there will be an effort to cut that spending even more on the IRS.
Okay, don't go anywhere. Stay here because Marc Short is joining us. He's the former chief of staff of Vice President Pence, as well as former Trump White House Legislative Affairs Director and a CNBC contributor. Ernie Tedeshi is also here, Director of Economics at the Budget Lab at Yale University, formerly the chief economist at the White House Council of Economic Advisors. Good morning to both of you. Marc, what do you think of the idea of taking the corporate rate down to 20%?
Well, Andrew, I think stepping back for a second, when we reduced it from 35% to 21% in 2017, it was in large part because we've seen a lot of jobs go overseas and companies in the pharmaceutical industry going to Ireland, manufacturing going to China and to Mexico. And it was an effort to bring jobs back. In the 2 years after signing that legislation, 5 million jobs were created in the United States. I think it was a great success. I think Donald Trump always advocated to bring it to 20%, to be honest. In our meetings, he thought that would be a round number that he could market better than 21%. So I think this is consistent from his perspective. I think it'll have a difficult time advancing additional tax cuts because I just think Congress is going to be very divided without significant margins on either side after the elections. But I also think politically it's smart to show a contrast between somebody who's continuing to advocate for tax relief versus where I think the Biden campaign will be advocating a significant tax hike.
Ernie, the Biden administration will be advocating for a significant tax hike. Having said that, it appears if you go back in time that the corporate world was prepared and almost happy for a 24%, 25% tax rate, that seemed to be acceptable to them. And in fact, so many of them, if you remember, were surprised when it was put at 21%.
Yeah, and the Biden, the latest fiscal year 2025 budget has proposed a 28% corporate tax rate. That sort of splits the difference between where it was in 2017 and where it is now. That would still be very competitive worldwide. I would go even further back, and I'd go back to 2001, which was the last year that we ran a budget surplus in this country. We had Social Security and Medicare at that time. We knew that there would be aging pressures on those programs, and yet the debt trajectory in 2001 was still downward. What has changed in the trajectory since 2001 has been multiple rounds of tax cuts and their extensions. According to the Committee for a Responsible Federal Budget, those tax cuts since 2001 have added $8.4 trillion to our debt. And so I think what the Biden campaign and what President Biden has proposed is a way of righting that change and fixing our fiscal trajectory by overcoming some of that.
Marc, the 2017 tax cuts were a tax cut for everybody. A lot of Democrats say it's only the wealthy and companies that got a tax break. Everybody did. They were also expensive, or they will be expensive if you extend them to, once they expire next year. How would you pay for that extension?
Well, I think that, to Ernie's point, I think that Democrats left always are looking to say that for Americans to keep more of their hard-earned dollars, we have to pay for it. Whereas if we want to do an Inflation Reduction Act or infrastructure bills that just spend more money, it doesn't have to be paid for. And I think if we go back to 2017 in Congressional Budget Office, they projected that tax relief would leave a $1.9 trillion cost. Halfway through those projections, they're now saying they underestimated revenue by $2.6 trillion. Revenue has increased every year to the federal government since we passed that tax relief, except for COVID year of 2020. America does not have a revenue problem. Both parties continue to spend way more than we should, and that creates the deficits. It's not coming from tax relief. Again, state, halfway through it, they now are projecting we're actually going to have in the 10-year window $2.6 trillion more revenue than they forecast. And so the deficits are not being created by a lack of revenue. They're being created by overspending from both parties.
So,
Ernie?
the reason why the reason why CBO is projecting more revenue is because growth has been stronger than private analysts have expected over the last couple of years. Revenue declined relative to GDP the year when the TCJA was enacted. It was corporate and individual income tax revenue was 9.7% of GDP in 2017. It fell to 9% of GDP the next year, 2018, the first year of the TCJA, which was almost exactly what CBO projected it would be. Look, it's very simple. You cut taxes, you lose revenue. There's a, growth effects offset a little bit of that, 10 to 20%. But here in the real world, when you cut taxes, they don't pay for themselves.